Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you started your portfolio but need some help continuing to grow, 2022 REB Buyers Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, Phil Tarrant, host, Smart Property Investor Show. Hope you're well. Sounded very serious there, but it is a serious news cycle at the moment. Lots happening at the moment. And what I really wanted to do today, we've got a whole bunch of investors lined up to come and have a yarn with us over the coming months, but I just really wanted to sort of bookend a lot of it with a bit of a update, a quick sort of snapshot, synopsis of what's going on in property right now, looking at some of the key headlines on smartpropertyinvestment.com.au, of which there are many, created by a very talented team under the stewardship leadership of our editor of real estate here at Momentum Media, Grace Ornsby. I've asked someone to come to the studio with me to help me navigate some of these issues, to give some interpretation analysis of them. Steve Waters, he's a director over the Right Property Group, good friend of Smart Property Investment and a semi-regular guest on the show. Steve, how you going?
Going well, mate. Thanks for having me back.
No, it's good to have you here, mate. And much like myself, I know you're highly connected with what's making headlines because it helps sort of shape the conversations we have on a day-to-day basis. I've got some key stories here I really want to get stuck into, mate, to get your sense of and what it all means on smartpropertyinvestment.com. The first one, this is something that been bandied around for a little while. New South Wales unveils shared equity trial for home buyers. I'll read a bit of this story, Steve. Everyone go and check it out on smartpropertyinvestment.com.au. But this is for first-time buyers, but there is ramifications for property investors. It says the state government has unveiled plans to trial a shared equity scheme for prospective homeowners in the state as it continues its rollout of housing initiatives tied to the latest state budget. The Premier said that 6,000 places will be available in a pilot project to be conducted over the next 2 years, which will see the state government contribute an equity share of up to 40% for a new property or up to 30% for existing properties purchased by eligible buyers. Estimated cost of the program totals about $780 million. News of the proposed scheme, Steve, first started circulating in February this year, is on the heels of a similar scheme being piloted and then instituted in Victoria. And it says, Steve, New South Wales trials will be available to first-home buyers, and the government describes as, inverted commas, key workers such as nurses, teachers and police, as well as older singles over 50 and single parents with a child or children under the age of 18. Pretty interesting stuff. Even the federal government's talking about doing something similar for first-home buyers. So these are two different schemes, right?
Yeah, it's interesting. I mean, as always, the devil will be in the detail. When they put forward a proposed pilot scheme, there's always that grey area where very few really understand the pros and cons of it. But it's a good step in the right direction. Not a lot of places in the scheme of things, but it's better than nothing, I guess. Look, this is on the back foot of what I believe a sure sign of what confidence over the long term they have in residential real estate, being an equity partner, I guess. And in some way, shape or form, it goes back some years ago now, or decades ago, where the state government anyways, were giving public housing tenants the ability to be able to purchase into that property as well via a quasi shared equity scheme. Now, whilst in this case, it's different in terms of who they're targeting, I'd like to see that they actually help all sectors. And I recognise this is only a pilot scheme, but there are other people on the end of the scale as well that are doing it very, very tough. And there is a big void in the amount of supply in terms of accommodation towards what is actually needed. Like, the gap has probably never been bigger. And once again, it's a pilot scheme. Ultimately, I hope it works, and I hope they roll that out to a lot more different people to really address that problem, especially at the lower end of affordability where people are doing it very, very tough.
Yeah, they say key workers though, but most of the key workers they've identified are government workers, nurses and cops and stuff like that, right?
Yeah.
Because they know pretty much their income's guaranteed, unless it's pretty hard to get punted. But they're probably gone for somewhere there's a bit more stability. But they were the people who were the sort of key during the COVID pandemic. It's good to look after them, get them involved. But there is devil to the details. But the question is, right, that's great for first-time buyers, but if you're a property investor, so what?
Well,
what does it mean?
I guess, there's an argument to say that, well, if you're taking out, let's talk existing stock to begin with. If an existing dwelling is purchased by an owner-occupier, then that's one less person in the rental pool fighting in today for that piece of accommodation. But as we've seen through multiple areas throughout Australia, that's not actually quite the case, because you're also taking a dwelling out of existence for the rental pool as well. So the net effect is arguable, I believe. Once again, I would go back to the lower end of affordability. Let's talk social housing. The government has made it very clear that they don't want to be developers. They don't want to be landlords. So they need private people to somewhat supply that accommodation for people, because there's two options. As a rich nation, we can create wealth across for the individual, or despite being a rich nation, if we look back, we've been totally negligent in and around public housing. And we're seeing that roll out right now, today.
Yeah, you are seeing it, and how it plays out over time, who knows? But to the point that you make, Steve, the very important role that property investors play in terms of providing housing. There's a story here again, smartpropertyinvestment.com.au. Investors wanted 12 Perth suburbs in dire need of rental supply. So the government ain't put it in there. They're looking for property investors to do it. Now, I'll read this story. There's an urgent need for more investors in Western Australia, as a new report showed that the city continued to grapple with a shortage of rental listings in May. Real Estate Institute of Western Australia reported there were 12 Perth suburbs with just one rental up for grabs at the end of the last month, revealing the depth of the city's ongoing rental supply crunch. The 12 suburbs included in the list, and let's have a chat through some of these, were Southern River, Lemming, Palmilla, Kingsley, Tabersham, Lockridge, Swanview, Hilbert, Manning, Medora Bay, North Beach, and Luca. REI President Damien Collins, g'day Damien, if you're listening, said the rental shortage remained a significant challenge for the state. Quote, for there to be a single rental available at any time highlights how important it is we attract investors back into the WA market. That's from the REI WA president. So interesting, isn't it? So pretty much going roll up, roll up, roll up. We need property investors here to be buying properties so people have got somewhere to live. Bonkers.
Like, would you have ever thought that there would be suburbs with one dwelling for rent? Yeah, it is an amazing situation that we have, and I don't mean in the positive, especially if you're a tenant.
Yeah.
But as we've talked about many a time, this isn't something that has just happened overnight. The first stone was cast back in 15-16, in and around those APRA decisions that didn't allow investors to invest because of the calculations in the background in and around serviceability and how hard it was for the investor to borrow, because let's not forget, the intent was there, but the ability wasn't. And there is a real chance that we could be experiencing that, albeit different trigger points today once again. So that problem that Perth, in and around Perth, is experiencing is a mirror image of what quite a few different areas throughout Australia are experiencing as well. And that problem isn't going away in a hurry. There is no quick fix.
No, and it's it's good to see Damien flying the flag for Western Australia. We both know Damien pretty well, so he's doing his job there. But interesting, I'll read a little bit more of this, Steve. Mr. Collins added that in several suburbs across Perth, only a handful of rentals available, making it difficult to keep up the high demand. Many of the suburbs highlighted on the list, like Kingsley, Southern River and Lemming, are large suburbs with more than 10,000 people residing in them. For there to be just a single rental available at any time highlights how important it is that we attract investors back to the WA market. So WA has been on the nose. Don't give me a hard time about that for quite some time for property investors. Pretty lackluster market. Come back a lot over the sort of 10 years highs back in, the late sort of 2000s, 09, 010. Not really attractive for investors. I know you've been out there, Steve, having a nose around. I think you were out there just before the COVID pandemic hit. But let's have a chat about some of those suburbs. Are they familiar to you? Are you?
Yeah, a few of them are.
Thoughts? investing in WA?
I think if you're as you should be everywhere, you need to be spot on where you invest, not just WA, anywhere. But as an aside, let's look at the reasons as to why they're in that position. And that is, quite frankly, because they didn't build anything for 15 years on the back end of the major boom that they have. And as you mentioned, Perth was on the nose. They had tremendous growth, unsustainable growth. And then when mining stopped and the mines were stopped being built, people left and people stopped building. And where they are today is somewhat a direct result of that. But we're in the same situation throughout other areas of the country. The construction industry, which is no secret, is in all sorts of trouble via lack of labour, lack of building materials because of the supply neck bottles. We're at the end of a finance cycle now. There could actually be a repeat of that throughout other areas of the country, but not today, because it's already bad today, but in the years to come, because we've already seen building approvals for new dwellings fall off the side of a cliff. Now you have people that have less of an ability to be able to borrow money to enter the market and supply that accommodation. So it's a vicious circle. It's almost a checkmate position.
Yeah, but it goes to show also that the pressures on rentals in Perth is not necessarily directed at just one sort of price point in the market. 4 of the suburbs included in the Dyer dozen had median price sales above 785 grand, right? North Beach, just shy of $1 million. Luca, the same. Manning, sort of 827, and Lemming, 787. So that's sort of higher end of where a lot of property investors operate. So a whole bunch in the middle, but then 5 had median sales below the Perth median of 525. So Chabsam 520, Hilbert 420, Swanview 410, Lockridge 332, and Parmelia, sorry if I got that wrong, it's just over 300 grand. So you can actually enter those markets at the lower end if that's where your price point is as a property investor. And to goes to show, as a clue, Steve, should you be buying investment property in areas that have a very, very, very low vacancy rate? Is that a good thing?
It's a good start, but you really need to dig a little deeper. And what's the why? Is it a transitional piece? Is it a flash in the pan because of the local economics there? Take a mine as an example. Now, whilst Perth is heavily reliant upon the resource sector, more closer to the mines, you start to see these ebbs and flows. And we've all seen the Hardlock stories over the years of, zero properties to rent and escalating rents through to the whole suburbs for rent or the whole area. So I would suggest to investors that they look beyond just what the current vacancy rate is and have a look at that pipeline analysis, or that pipeline supply, I should say, and what are the drivers behind it? Is it seasonal? Is it transitional? Because you don't want those flash in the pan areas. You really want consistency and sustainability, because that's your cash flow.
And you answered that exactly as I expected you to answer it, and that was the right way to answer it.
I pass.
Yeah, pass. One of many indicators that you got to be curious, right? Be inquisitive.
Yeah.
Ask those cascading questions to satisfy yourself whether or not what you're seeing at a frontline area, there's something not sinister behind it, and that's what the smart investors do. Steve, a whole bunch of other stuff I want to run through. We're just going to go a quick break. Stay with us, everyone. Back in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with Right Property Group's director, Steve Waters, on the line with me, having a yarn around what's making headlines at the moment. And if you're new to the podcast, go and check out smartpropertyinvestment.com.au, daily market intelligence information to help you shape your investment buying decision. Now, Steve, this is something I know a lot of people have gone down this pathway, and a bit of a double-barrel sort of scenario I want to run with you here. The Brisbane Council, use the headline here, Brisbane Council cracks down on investors operating, inverted commas, pseudo hotels. I'll read a bit of this. A crackdown on short-term rentals will see Brisbane property owners pay substantially higher council rates for operating holiday homes, with the local mayor lamenting different tenants coming and going. Brisbane's Lord Mayor unveiled the Queensland Capital's budget on 15th of June, which included a steep hike for property investors trying to make money from short-term rental accommodation, that when they pay 50% higher rates than those who rent out the properties on a long-term basis. I acknowledge a pressing housing crisis facing the city. During a speech introducing a new budget, he zeroed in on the rental market in the area in need of intervention. I'll read this quote, Steve. With the rental vacancy rate now at record lows, it's incredibly hard for tenants to find affordable places to live with 6 to 12-month leases. Short-term rentals may be convenient for tourists and visitors to Brisbane, but they throw up a minefield of issues. So 2 ways to look at this, and we spoke about it before the break, around those 12 Perth suburbs who only have one rental available. Brisbane is also experiencing challenges around vacancy rates. I'd like your views and opinions on that. Do you reckon it's going to matter, though? If you hike up rates by 50%, that's cost to operate business. It might still be more economical to run as a short-term rental, Steve.
Look, it could do, but I not that I necessarily agree with the mayor on what he's doing or how he's going about it, but I appreciate what he's trying to achieve, and that is to get those Airbnb style properties back into the general pool for the long-term accommodation to take care of the crisis that they have up there. But on the other side of the ledger, they're still punishing investors who have gone out and taken a commercial risk and are just looking to extrapolate what cash flow they can to negate an element of the risk associated with it and doing something that's outside the square. Personally, I'm not a fan of the Airbnb strategy. I respect it, but it's just not my strategy. I think people, toward your point, will kick and fight and scream and carry on, but there'll be an element that will just say, well, I can't go past the good cash flow and I will absorb the cost, and potentially it'll just increase the rates of Airbnb if the demand is there. And especially because Queensland is heavily tourism based in some way, shape or form, are they throwing the baby out with the bathwater? Yet to be seen.
Yeah, it's a big one. And what are you seeing in terms of vacancies up in, we spoke about Perth, but in Brisbane, is it as dire as what is in Perth? Is it that tight, the vacancy rates for houses?
I would suggest that it is, because their population continues to go through via intrastate migration numbers, and they just can't build. No one can build, for that matter, anywhere. Yeah. So there are challenges all around it. But we're seeing the vacancy rates there as a ground truth component a lot lower than what's being reported. And certainly rents are escalating at a very, very fast pace as a percentage-wise. And that problem as well is not going away. And you can understand why people are wanting to move to Queensland, whether it be from an affordability piece, lifestyle, jobs numbers are great. There's a lot of things going for Brisbane that are enticing people to want to move there. And that's just putting further and further pressure on what lack of supply that there is. Is the problem going away? No. Is it very, very tight? Yes. Will it stay that way? Absolutely.
Probably. Yeah. And capital values continue to increase in those housing markets as well. Still bubbling along there, right?
It is. It's doing its organic growth pattern now, probably is a way to describe it. The heatiness has gone, and so it should, because it wasn't sustainable. It wasn't healthy. But because of the relatively good yields compared to, say, Melbourne and Sydney, the affordability component, as I mentioned, and the escalating rents, it makes it, I guess it's underpinned the value proposition there to help accommodate the rising cost of money being interest rates.
Interesting. And, I look at the Brizzy market, and we got a lot of property out there. We chat a lot about it, and it's still it's doing its thing finally and thankfully. But, the whole Airbnb scenario is sort of trying to penalise property investors for following that strategy. I think of that, and I know a lot of people have bought these sort of lifestyle type assets, or haven't bought them specifically for the purpose of renting them out full time for short-term rentals. Think about the Northern Rivers area of New South Wales, for example, and there's sort of equivalent areas in Melbourne where you've seen significant price rises. Take Byron Bay and the Byron Bay hinterland, which is part of that Northern Rivers. A lot of Sydney-siders or Melbourneites have bought property up there on the basis of I'll use it when I'm in town for holidays and I'll rent it out short-term, much to the disdain of locals in those areas who have been priced out of renting properties because everyone who's buying places are putting them on the short-term market, which has got its own dynamics. But international borders have opened up. A lot of those people who were buying and holidaying up in those areas now are looking further afield offshore. You only need to look at passport lines to see how popular international travel is. I think NAB came out the other day, Steve, pretty much saying credit card spending internationally on Aussie credit cards is through the roof right now. There's a lot of people out of town spending their bucks outside of Australia, even though it's a great place to visit. I reckon there's going to be some challenges to those markets moving forward, and you're probably going to start to see some of those properties going back onto the long-term rental markets rather than being Airbnbs.
Well, then essentially, the plan has worked, or at least what Brisbane City Council is doing. And whether other council areas for the same asset strategy do the same thing is yet to be seen. But I also will note in and around rates that large parcels of New South Wales and Sydney have just had an escalation of up to 2.5% on their rates notices as well due to inflation. It's just that Brisbane City Council have just gone up 50% for that type of property. But it could have a bearing on the long-term value proposition if other areas take on that play as well in terms of council areas. And perhaps maybe we will see those holiday-driven areas. It'll be another piece of the puzzle to flatten prices, potentially.
Yeah. Watch this space. I look forward to seeing how that plays out. Now, this upwards rate environment we're in, big discussion on this podcast, Stephen. I know amongst yourself and your colleague, Victor Kumar, you chat a lot about is keeping an eye on the bottom line. So financing this market is absolutely key. I want to have a chat about that. We'll just go to another quick break. Stay with us back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. Phil Tarrant with Steve Waters chatting through what's making headlines. Now, Steve, I think this is something you maybe coined. Property is a game of finance being absolutely critical. So as interest rates start going up, unless people's income isn't going up at the same rate, their serviceability equation is probably going to start changing. So they're going to be able maybe borrowing less if they are buying right now, or needing to tighten their belt in order to keep their investment properties. A really good story here, and this is something which has been sort of thrown around all over the joint recently around sort of this BNPL stuff, which is buy now, pay later. Story here: do banks pay attention to borrowers' buy now, pay later debts? I'll read a little bit of this out, Steve. The Australian Prudential Regulation Authority, which is APRA, has clarified whether home loan providers should include debt accrued through buy now, pay later schemes when assessing a borrower's debt to income ratio. APRA has finalised amendments to its prudential framework that were proposed in November 2021. Following a consultation process with industry participants, new measures will come into effect 1 September 2022. Among the macro-prudential policy credit measures the regulator hand down was a clarification on whether debts accrued through buy now, pay later platforms like Afterpay, Zip, Hum should be included in assessing debt-to-income ratio. Whether government higher education HECS payments also should be included with DTI assessments. The regulator confirmed that DTI, debt-to-income, should take stock of the ratio, quote, the ratio of the credit limit of all debts held by the borrower to the borrower's gross income, and they have specified that BNPL and HECS or HELP loans fall into this category. So if you think that buy now, pay later, and this is what they would argue, that it's not a credit product, is not credit, the regulator, prudential regulator, APRA, has come out saying, yes, it is. And if you have those debts, the bank is going to therefore shape your serviceability as a result of it.
I think if we replace the word credit with commitment, it would make clearer sense.
It would do.
And ultimately, what is the commitments that you have? I mean, that's assessing risk from a lender. And on the surface, I actually agree with that. Yeah, we want a responsible, healthy lending system, that we don't have a repeat of the early 2000s, or even worse, what the American non-recourse lending to some degree. Yeah, that held us in good stead. And we want to continue in that fashion. And I think it is the consumer's responsibility as well to actually know what they can and can't afford and what other payments or commitments they have. As we've often talked about, Phil, there are two types of affordability. One is what the bank says you can afford, and one is what you really know you can afford. And often the two don't meet on either side, up or down. So there has to be a little bit of self-care here and responsibility on the consumers or the borrower's part. But we know through history that that's not always the case. So I'm actually an advocate for it, because I don't want to be penalised as a responsible lender, a responsible borrower, I should say, further down the track, and have to help prop up the system because of all that debt that perhaps was where they got it wrong. So I'm all for it.
Yeah, I completely agree. And there's a commitment. And you might think buy now, pay later. I'm not paying interest on it because I'm paying it off per the payment plan. But if a bank or a lender is assessing you and they see you perpetually enter yourselves into arrangements on a buy now, pay later basis, they're going to assume that you're going to continue to do that over time. You might go to lender, oh, no, give me a loan and I'll stop doing that. They're going to go, well, yeah, nah, that's not the way it works. So if you want to present yourself as best as possible to a bank or a lender as someone who should be taking on further debt for the purpose of buying investment properties, you got to clean up. You got to clean up yourself now because it's going to get a lot harder moving forward to borrow probably at the levels that you want to borrow at, because all this stuff is going to be assessed. And what it's going to mean is going to reduce your ability to borrow money. So you're seeing it right now, Steve. A lot of property investors are looking back at their bank statements and saying, how do I clean this up? If you see Uber Eats, same thing. You go to a bank and you go, you give me a loan, I'll stop eating Uber Eats. They're going to go, no, I can see a history there. You're not going to chop. You're not going to change. Start showing this as part of your financials when you present it to the bank, that you are able to curb your spending because you have curbed your spending. All that sort of stuff, dining out, buy now, pay later, Uber Eats, spending. It's
all the discretionary spending.
Discretionary spending, there you go.
Correct.
And that's where you need to start. If you ever want to invest in property, you got to start doing that before you even start thinking about what do you buy, where do you buy it, and why do you buy it. It's all relevant.
And absolutely, it's relevant. Maybe, to sound harsh, what do you want more? Do you want the ability to be able to perpetuate your position, hopefully in an upward trajectory, or do you, want to live a life on credit?
Yeah.
And, I would suspect that whilst we have very, very low credit card debt relevant to the last 3 decades or thereabouts, there is a very good chance now that the cost of living is escalating that we'll start to see those credit card sort of debt numbers start to rise. And, the mother of all evil is when you speculate debt and leverage it.
Absolutely. And again, on finance, a lot of people enter the market for the purpose of investing, young investors, by leveraging the equity in their parents' properties is a good start for many people. A lot of people do it for buying a home to live in, but a lot of people use it for the purpose of investing in property. Good story here, Steve. We'll conclude with this particular one. Finance related as well. Experts warn that the bank of mum and dad could become a ticking time bomb. New research has revealed that the homeowners in a number of New South Wales local government areas are at risk of losing their properties, with parental gifts outlined as a probable culprit. The bank of mum and dad, the Bow Mode, was the 9th largest Australian lender in 2021, Steve, dishing out an astonishing $34 billion in loans through the year. However, Bank of Mum and Dad lending comes at grave risk of default, with experts warning that borrowers who loan money for their parents to purchase are twice as likely to default on their mortgage within 5 years, according to analysis from the National Property Group. So a lot of people are drawing down on this in order to get into the market, number one. But number two, if you're a bank of mum and dad and you're using your equity in your loan in order to propel your kids into property, you may risk falling into negative equity in this particular cycle, which might be okay. But if you want to sell your property, if you're down a retirement pathway, it might hold you back a little bit. So just be warned.
Yeah, it's an interesting one because there's 2 types of, what do you call it? Bow Mode.
Bow Mode.
Bank of Mum and Dad.
Everything's got an acronym these days.
It does. I guess it depends on what type. Were you a guarantor for the loan, or were you using a portion of the equity from the home to give? I'm surprised and a little dubious, to be honest with you, that those numbers are that big in terms of the default rate and how they would assess that and how they would come up with it. I don't know. I don't totally believe in those numbers. However, depending on where the parents or the mum and dad are up to in their transition into retirement, whether they're 2 years out, 10 years out, 20 years out, whatever it may be, I think that'll probably be where the potential drama could be. If you're 10, 20 years out, well, that's a hell of a long time in property. So yeah, the asset value may contract a little bit depending on where it is. But if we keep that long-term horizon, we know it will rectify itself and then some. But if you're in a position where potentially you are transitioning into retirement, well, then that could be a problem if the kids don't pay. And that's ultimately what it comes up to.
Yeah. Well, the numbers here, it says a staggering 60% of first-time buyers across the state receive financial assistance from their parents to fund their purchase, Steve. Most notably in Sydney, Blacktown, Ryde, Queanbeyan, Ryde and Blacktown, and then Queanbeyan, Albury, crossover, so regional and metro places. Madness.
It is madness, but when you look at it sort of a little deeper, some of those areas, it was cheaper to own it than it was to rent it.
True.
So why not take on the mortgage as long as, they can afford it and you can afford it? And you'd hope that as parents, and when I get to that stage to potentially help my kids out,
give them nothing.
They'd spend it all. It's, that I would probably assess them accordingly, to make sure that they can afford it, because I don't want to put them under any duress. And I'm sure every other parent does. You're going into it with all the right intentions to help your kids out. Isn't that our responsibility? Do, right? Isn't that our responsibility? And how is it any different, I guess, other than that transition to retirement piece of a bank scenario? You don't pay. Maybe there was some smart people out there that set it up right as well. Maybe.
Anyway, Steve, that was pretty good, mate. We covered some ground there.
We did.
Interpretation of what's going on. Thanks for your time. We need to get you on to have a chat about the smart property investment portfolio as well. We're going to do offline a bit of a review, mainly around sort of rents, whether or not are on the mark or they're underweight at the moment. So once we do that body of work, we'll come in and we'll have a bit of a chat about it on the podcast. So I think a lot of people will benefit from the process we do around that.
It'd be good to see what the position is. Knowing the rate of escalation of the rents. I'd nearly bet that we are behind somewhat. And it's very easy to get behind, over a 12-month period because the market or the rental market is escalating that quickly.
Yeah, and also I haven't really done a price review of portfolio for a while, whether or not prices already come back as far as where I've got my numbers for my properties now, and particularly in Sydney, but I haven't really factored in any growth in Brizzy recently over the last year or so. So I reckon I could probably do a bit of a review in that regards, whether or not that's just going to absorb softening of prices in Sydney. I don't know, but we'll do that body of work and we'll come and have a bit of a yarn about it, mate.
Absolutely.
Excellent. Look forward to it. That's Steve Waters from the Right Property Group. I'm Phil Tarrant, Executive Editor of Real Estate at Momentum Media. Hope you enjoyed the podcast. Please keep those reviews coming wherever you are listening to this, most of you on the Apple iTunes. The team get a real kick out of seeing those positive sentiments coming through as you shape your investment journey. Smart Property HQ is where you'll find us on the social media. That's how you like to get your info. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.